The fund aims to invest in 30 to 60 stocks, primarily in North America. It's benchmarked to the Russell 1000 Value Index, and the fund has a dual mandate of financial outperformance and ESG outperformance. Specifically, the fund aims to deliver an attractive level of income with capital appreciation over the long term. It also aims to deliver a premium ESG profile through superior ESG scores and lower carbon emissions intensity versus the benchmark. The fund's objective is to build a high conviction portfolio of attractively priced, high quality, dividend paying companies that are either ESG leaders or ESG improvers. The fund offers a unique combination of alpha and ESG outcomes in a value strategy focused on the US market. It leverages not only the deep resources of the income and value team here at BlackRock, but also the breadth of resources across the broader firm. There are two factors that differentiate us from other sustainable funds. First, most funds focused on sustainability have strong growth biases. That's because these companies tend to be rated highly on sustainability. For those who care about sustainability but worry that growth stocks have gotten overextended, value is a good place to be, especially higher quality, dividend-paying value stocks. The second differentiator for this fund is that we believe that continued investment in traditional industries is necessary for a successful energy transition. Pure divestment is not the answer. For example, we are invested in several oil and gas companies, which are very attractively valued, generate a lot of free cash flow, and are investing for the future. The process for the BlackRock Sustainable American Income Trust starts with the team. The lead portfolio manager for the fund is Tony DeSpirito. He's also CIO of US Active Equities at BlackRock. He works alongside me and fellow co-portfolio manager David Zhao. We are supported by a team of approximately 20 fundamental research analysts who are responsible for conducting deep research on the companies they cover. For the fund, we seek to construct a portfolio of 30 to 60 attractively valued stocks, primarily within North America, with superior ESG traits. Unlike some firms, we believe ESG research is most powerful when embedded into the work of our fundamental analysts. Our investment analysts are sector experts. They are best positioned to identify and analyze the key ESG factors. One other advantage of the investment trust structure is the permitted use of gearing. This allows us to borrow money for investment purposes. We have the flexibility to gear up to 10% of NAV, with 5% viewed as a neutral level within the 0 to 10% range. We think of potential investment opportunities on a 3-year time horizon. We start with our investment universe, which consists of large and medium-sized companies in North America. We layer on top of that ESG exclusionary screens, which help to focus this universe. New ideas are sourced from 3 places. The first and primary source are our research analysts. They leverage their sector expertise to identify the most attractive ideas for further investigation. Our second source are portfolio managers. They leverage their breadth of knowledge to identify potential mispricings. The third and last source is our internal quantitative research screens. Next, we collate all of these ideas and prioritize them to form our research pipeline. Then our analysts start to dig in. They hone in on the industry outlook, the competitive dynamics, the economics of the business model, and the outlook for growth and cash flow generation. In addition, they seek to understand the materiality and outlook for different ESG and sustainability factors. In this process, analysts will speak to the company, competitors, customers, and suppliers to inform their views. This research process is exhaustive by design and culminates in a formal deep dive research piece and recommendation that is presented at our team's weekly investment review meeting. The BlackRock Sustainable American Income Trust has a value strategy. We're benchmarked to the Russell 1000 Value Index, so the fund performs better in environments where value does well. Now, there are two environments where value tends to do well. The first is coming out of the recession. We saw that in the second half of 2020 and in 2021. The other period is in times of higher inflation and higher rates. This is what we're seeing now. We're seeing higher commodity prices. Supply chain shocks are driving higher freight and transportation costs, and the lack of labor is driving up wage inflation. This sets up well for a value strategy. Traditional value sectors tend to benefit in a rising inflation and rising rate environment. Take financials. They make money from the steepening of the yield curve, and inflation is beneficial for the steepness of the curve. Take energy. Energy companies directly benefit from higher commodity prices. Lastly, value also tends to outperform growth during these periods of rising rates, simply because growth companies have more earnings in the future. When the discount rate goes up, their net present value comes down.